Hi there, I'm Mindy Jensen.
And I'm Carl Jensen.
And this is the Mindy
and Carl
on Money podcast, where we talk about what happens after you reach financial independence.
Why do we call this show Mindy on Money?
Because Mindy knows everything isn't quite accurate.
You always say you know everything.
I know, but it's not actually true.
I like your new humble turn.
Please.
What percentage of stuff do you know would you say is over or under 99%?
Over.
Over? Okay.
So, but I don't know everything, so it's not quite accurate.
Wow.
So we call this Mindy on Money instead. On this episode of the Mindy
and Carl
on Money podcast, Carl and I answer listener questions with Sean Mullaney. And when we say listener questions, we mean our own questions. We're the listeners, Carl and me.
Yeah, this show is going to be a little bit unconventional in that we talk about investments, but not so much index funds and a little bit of tax strategy, but this is going to be some stuff that pertains to us, and I know it pertains to a lot of you too, like stock market valuation. Are we entering a recession, and what you should do about that? So I think this turned out to be a really neat episode.
Yeah, when I say we are the listeners and we're answering our questions, we are, but also they're not questions that you've never had. These are questions you've been thinking about too. So you will get a lot out of this.
But before we get started, let's take a quick break. Today's episode is sponsored by us. What? Wait.
That's right, Carl. Today's episode of Mindy
and Carl
on Money is sponsored by Mindy
and Carl
on Money podcast. We'd like you to subscribe to our show, which you can do by going to mindyonmoney.com/subscribe. While episodes usually air on Wednesdays, every once in a while, we'll have a bonus episode, which you can stay on top of by subscribing. All right, today we have a special guest, Sean Mullaney from Mullaney Financial Tax. Sean also writes the FI Tax Guy blog. Sean, I am super excited to have you talk to us and answer our mailbag questions, which were sent in by two listeners, me and Carl.
Mindy and Carl, it's a pleasure to be here. Looking forward to the conversation.
Thank you, Sean. Yeah, these are the crazy thoughts that rattle around our heads. And I think this episode is going to be a little bit different because we have unintentionally played around with the stock market more than most in the FI community. I know index funds are all the rage, and I completely believe in them and endorse them, but I have a confession. I first learned about them, I think I didn't even know about them.
From J.L. Collins.
Yeah, I learned about them from J.L. Collins. So in 2013, when I started my financial independence journey, I had no idea what an index fund was. I knew about mutual funds and 12B1 fees and some of that stuff, but it wasn't until 2015 that I learned about that. I think it was around that time, and it made perfect sense, completely obvious, super logical. It's the right thing to do. But as a result of our previous life as stock pickers, we still hold some investments that are probably atypical for the FI community.
They're not probably atypical. They are atypical. Also, I'd like to point out that, or I'd like to admit that I was today years old when I first heard the phrase 12B1 fee. So thank you again for continuing to educate me.
Sure.
It is a journey. But yeah, people may or may not know about those. That's not the subject of today's show because I actually didn't hear about that until 5 seconds ago. What is the subject of today's show is our questions, because I feel like if we have these questions, other people in the FI space have them too. So, Sean, are you ready?
Let's rock and roll.
Okay, Sean, people keep waiting for the market to crash. I don't know if you have heard from anybody saying, oh, the market's overvalued, I'll just wait until it crashes. What is your opinion of the current stock market valuation?
Well, I step back and I think about 3 years. Unfortunately, we're all middle-aged here, so we can remember all 3 of these years. Think about the year 1999, the year 2007, and the year 2019. Okay? Those years were sort of the roaring stock market years. I remember I was in college in 99 and it was like, we're all going to be billionaires and everybody's watching CNBC and the Wall Street Journal. Stock markets everywhere, right? Everybody's having conversations about the stock market. And of course, .com, 9/11, it cratered, right? And similar in 2007 going into 08, similar in 2019 going into 2020, right? Let's think back for a second. Was the stock market overvalued back then? Maybe yes, maybe no. But isn't it irrelevant for all three of us and for the folks in the audience? And look, I'm not giving investment advice to you guys or to anybody in the audience, but I'm just here to say, isn't it mostly irrelevant, right? If we had bought stocks at the highs in 99, 2007, and 2019, and that's the only time we'd ever bought stocks, and we hold them today, aren't we happy we bought those stocks, right? I also think about this from, well, in the FI community, we can sort of break it down into we're either accumulators or decumulators, all right? So think about an accumulator, and assuming we don't have a huge inheritance or a trust fund situation, we're going to be in the accumulation phase for at least 10 years, and probably more like 20, maybe 25, maybe 30, maybe more. So at various points in that 10-year, 20-year, 30-year horizon, we're going to be buying in, right? Why do we care about the valuation, and is it overvalued or undervalued at any one point in that 20-year time frame? Right? To my mind, it's sort of irrelevant. Yeah, maybe it is overvalued. I don't know. But it's sort of irrelevant because I've got 5 more years, 10 more years of accumulation. And oh, by the way, I've already had 10 or 15 years of accumulation, right? Flip it to decumulation. Most of us in the audience are hoping for many years of retirement, of decumulation. The same thing, but it's even starker in the sense that no one in the audience is going to need their entire portfolio on any one day. And this goes to sequence of returns risk, to 4% rule. But, we say the market is either under or overvalued on, date X. Well, I'm going to have 30 years of date X's. So why do I care that much about any one particular day? So I don't have much of an opinion as to whether today's market is overvalued or undervalued or what have you. But I sort of think it doesn't matter that much.
Yeah, I agree with this. The core message is that all of us should be in it for the long term. We're not investing for weeks or months or years. We should be in it for decades, especially at our age. And thinking about our situation, even if we had to sell something in a decade, it would be a very small percentage of our portfolio, so it just doesn't matter that much. Another weird thought that I had recently, Sean, I'm not a dividend investor. I actually don't like them because forced taxes and all that kind of stuff. But I was looking at our portfolio, and just because we saved hard and a lot, the odd situation that we're in is I'm not sure that we'll ever have to sell much of anything. We'll probably just be able to live off most of the dividends just from an index fund, which was pretty startling and maybe a little bit jarring in a good way for me. It was a little bit of an epiphany.
I like that, what you said. You are looking at it and realizing this. I encourage everybody listening to really dive deep into your holdings and see what sort of dividends you have coming back, where your money is at, what sort of returns you're seeing. One of my favorite charts on the whole internet is it's on a website called macrotrends.net. And I got there just by searching the historical returns of the stock market. And you see this chart that goes from, I don't know, the oh my goodness, you can go back even more than this, from like the beginning of time to now. And when you zoom out, it's up and to the right. When you zoom in on any given period, even on any given day, you're going to see ups and downs. That's how the market travels. So I think your point was very good. It doesn't matter what it is now because, well, I'm paraphrasing. This is what you said, but whatever it is now, it's going to go up and to the right eventually. And you can see these giant dips in 2000, in 1999 leading up to then 2000 and then 2008. And, even I can tell where 2019, 2020, that big March 2020 drop was. And I'm not even zoomed in on this. I think this is a great thing. I will include this link in the show notes. Zoom in and really look at these returns and see, price doesn't matter. I'm going to paraphrase there, Sean. So thank you so much for that. Another thing about just investments in general, I have said many times, if you don't understand it, you shouldn't be investing in it. And I mean this for things like cryptocurrency. We are currently 0% in cryptocurrency. And depending on who you talk to, that's either a very smart decision or the worst decision we could possibly ever make, because look at how fast crypto grows, and you're going to be a batrillionaire, or at least you would have been if you would have invested in crypto. And it sure would have been nice to, ride those gains. But if I don't understand it, I don't think it's a good thing to be putting my money into. But there are plenty of people who also say they don't understand the stock market. I think it's completely fine to invest in index funds without really understanding them. But I don't think that that's really taking my advice into account. So where would you send somebody to learn about how the stock market works so that they can feel comfortable investing in index funds?
So I'll give you three resources. Two are very affordable. One would require a bit of a spend, right? So first resource would just be the J.L. Collins book, The Simple Path to Wealth, right? He talks about building up financial assets as an individual investor and what that looks like. And I think that's just a fantastic resource in terms of, do you want to learn about these investments? Okay, so that's one resource. And that requires a bit of a spend on Amazon or Barnes & Noble. No big deal. Second resource is entirely free. And I could send you a URL to put in the show notes on this. This is an article that doesn't get enough attention, in my opinion. It's an academic piece, but it's only about 5 pages. It's from a very prominent finance professor. I believe his name is William F. Sharp. And it's called The Arithmetic of Active Management. And what it does is it just breaks down active versus passive management, which is one of the most fundamental concepts in terms of, are we going to invest in the stock market? We have to understand what active management is, what passive management is. And he does this really neat arithmetic formula. And he says, well, let's just say 60% of the market is actively managed and 40% is index funds that we all talk about all the time in the FI space, right? Well, the whole idea behind passive investing is that you're getting the market rate of return. So if it's 10%, then we know that the passive rate of return is 10%. If we do a little bit of arithmetic, we find out that the rate of return on active management must also be 10% in the aggregate, right? Literally, it's 0.6 times 10% plus 0.4, in my case, 40% passive, times 10% equals the rate of return 10%. Okay. Well, then you say, well, is there a difference between the two? And there absolutely is. In expenses, that's the difference, right? So if by definition, on the aggregate, passive investing is going to do better than active investing because they'll have the same rate of return, but then you have to subtract out the expenses, right? So that'd be a second resource, the Sharp article. And then a third one that would require time and money, but I think it might be well worth it for many in the audience, especially if you just don't have any idea about investments, is something called the Bogleheads Conference. It happens once a year, and I think it's a $500 admission, something like that. This year it's in late September in Minneapolis. And one of the things they do on the Friday afternoon, they have a 101 afternoon panel. It's like 2 or 3 hours, and they go over some of the Boglehead basics, which has a lot of the investment basics in it. So I think those would be my 3 resources: The Simple Path to Wealth, the Sharp article, and the Bogleheads Conference for those looking for some resources around what is this investing thing and how do I do this investing?
Yeah, those are all great points. I kind of wish I didn't pay as much attention to this stuff as I do, Sean, because I think it's pretty interesting and I'm fascinated by it. But I'm thinking about J.L. Collins now, and he said his daughter could not care less about any of this. So he said, okay, just go invest in index funds and don't look at it. And she's like, well, good, because I don't want to look at any of this. And she'll probably be far more successful than most investors. It's like a car accident. I can't help but look at it and look at it frequently. Now, I don't take action, but I guess it's my form of entertainment. I don't watch TV. I watch stock charts.
Nerd.
Yeah.
Well,
Okay.
Carl, I think the most dangerous thing here is accidental success, right? So you go buy an individual equity, right? You think you know what's going to happen with that equity, and it goes up. So let's say you buy an equity, 6 months later, it's up 40%. Now you believe you're really good at stock picking. And that may have gone up 40% for any sort of reason, right? So success can be very dangerous here, right? So now we think, oh, I can pick 10 stocks, I can pick 20 stocks, and perhaps you can, perhaps you can't. A lot of these stocks ride the waves too, right? There's volatility. There's, hey, the market's up today, so Acme Company's up today. Was it because you were a great stock picker that Acme's up today? Or maybe just the market in general is up, and maybe that doesn't really tell us much about your ability to pick stocks.
Oh, Sean, you're speaking to my heart. Mindy and I were having this conversation just like 2 days ago. We bought Google when it IPO'd in 2004, and we bought Tesla way back in 2012. And I'm not convinced that I have any intelligence about stock picking. I thought they were cool companies, and there's not much more to it. But the other issue with that is when something like that happens, then you have huge capital gains, so then you have that keeping you from doing the rebalance that you probably should do. And I think this leads into our next question, if you still believe.
Yeah, that leads into our next question, which is inspired exactly by what Carl just said. For a balanced portfolio, you don't want a significant portion of your net worth with one company. How do you navigate this versus investing in a stock that exponentially grew? Because you start off and you're like, okay, as a stock picker, we started off as stock pickers instead of index funds because we didn't know anything about that. And Carl decided to invest in Google because way back in the 90s, they were an amazing company. They still are, but like it was an amazing company. He was having great success using it at work. And he's like, this is probably going to grow based on my experience with them. So I'm going to put, how much did you put in there? Like $30,000?
I don't even remember. It wasn't enough.
Well, no, it wasn't enough. We're neither here nor there. Let's call it $30,000. We put $30,000 into Google. Let's also, for the sake of argument, say we put $30,000 into Tesla. So now we have other investments too, but now we've got that much in these accounts. However, they have grown exponentially. So we still believe in the long-term viability of both companies. And now they are an outsized portion of our portfolio. We don't really want to sell them because we still feel like they have more growth available. And this isn't stock advice. This is just our personal experience. But if you still believe in the stock, even when it has its up and downs, you don't want to sell it. Is there any point that you would, in your personal investing, because this isn't advice, is there any point you would say, you know what, there's too much in these, I need to rebalance? You know, you don't want to fall victim to an Enron situation. And I know we're dating ourselves then, but everybody knows we're old. Enron collapsed, and it spectacularly collapsed. And what was so pointed about that is there were a lot of employees that had their entire retirement fund invested in Enron stocks because I don't know if that was a 100-bagger or not, but it was growing and growing and growing, and all of a sudden it was worth zero. So, you know, I still believe in Tesla and Google, or, you know, if somebody's listening, they believe in their XYZ company, but you don't want to fall victim too. So how do you deal with this?
Yeah, I several thoughts, right? One is that stock in, say, a Roth IRA or a traditional IRA or something like that, you could re-diversify out without a tax effect, right? If it's employer stock, that can require some additional considerations. But if it's in a Roth IRA and it, 100x'd, you've won, right? You use that to shelter a huge capital gain. You can now redeploy, no additional tax, or reinvest, no additional tax consequences, right? But, I think, Mindy, what you're mostly saying is taxable accounts, right? Most folks have, or not most folks. Most folks that have very significant appreciated positions tend to have them in taxable accounts. So then what do you do? And I think the first thing you have to do is look at it in proportion to the rest of your financial life, right? Mindy, if you were coming to me and saying, hey, Sean, I'm worth $4 million, say, and $3.5 million of it is in Google, right? You got a problem, right? I mean, unless you're spending $20,000 a year or something like that, you have a big problem. But maybe you come to me and you say, hey, Sean, I'm worth $10 million. I've got 3.5 of that 10 is in Google. And oh, by the way, we spend $150,000 a year. At that point, you say, well, yeah, we don't want Google to go from 3.5 million to zero, but in theory, you're just fine, right? You got 6.5 million in other assets. You got 150,000 of annual spend. You're going to be fine, right? But then you say, well, what are the tactics you could deploy to sort of manage this position? And one of them is really good in the financial independence world. It's live off that equity in early retirement, right? So we have very favorable capital gains tax rates in the country for long-term capital gains. So what you could do is if you can get to early retirement, you say, hey, I got to live off something. Well, I have a big built-in gain stock, Google, Tesla, NVIDIA, Apple, whatever it is. And the first thing I'm going to live off of is shares of that, or I'll just make some sales of that Apple stock. Okay. What you're doing is you're using your own living expenses and the fact that you got to early retirement to help de-risk your portfolio, right? You got to live on something. You might as well spend down the undiversified asset so that the rest of the assets in the portfolio can keep growing, and they grow, they're more diversified. You start hiving down the undiversified position. So that's one tactic. Another tactic would just be to lean in and do some taxable sales. Now, there's something called tax gain harvesting, where if you can keep your income low enough, it could go at a 0% federal capital gains rate. But even if, hey, our income went up to $200,000, you'd be surprised how little tax you actually pay on that. If we have a $200,000 capital gain, we sell some Apple stock, redeploy into a diversified index fund. Great. That's something that could be done as well. The third thing is, somebody like the two of you probably should never whip out your checkbook or a credit card for charity again in your life. Now, I'm not here to say don't be charitable. What I'm here to say is, boy, you guys have this nice appreciated asset, right? In your case, it sounds like it's Google and Tesla stock. Well, what you could do is you could do sort of two different things. One thing is you say, hey, we like this charity so much, we want to give it $10,000 tomorrow. You can work with that charity and just give them $10,000 worth of appreciated stock. Most charities will take that. There's going to be some paperwork, but the thing is, you don't sell the stock first. You just send off the appreciated stock. You can get a tax deduction for the whole amount, and the capital gain goes with it. You never have to pay tax on that capital gain. So you can get potentially two big tax benefits right there. The other thing is you say, well, we really like this charity, but we don't want to send them $10,000 this year. We want to send them $1,000 each year and then step it up to $1,500 and eventually $2,000. You could set up what they call a donor advised fund and just use $10,000 worth of those Google shares to fund the donor advised fund. You get the upfront tax deduction. You get that capital gain off your future tax returns. And it normalizes the relationship with the charity. It's great, right? Donor advised funds are becoming a big retail level planning tool. They're fantastic. Very much fond of them. And then I'll share two other potential options. One is, if you're that first person I was talking about, hey, you've got 4 million and 3.5 million in Google, you might actually want to look into a more sophisticated financial arrangement called a put option. Right? That's where you get a contract that says you have the right but not the obligation to sell that particular stock or some quantum of it at a floor price. And you're basically locking in a floor. Now that has a cost, right? You have to reach out to an options broker. Certainly not an everyday type financial transaction. But if you were in that case and 70-80% of your wealth is in one stock and you don't want to trip a huge capital gain, that could be worth looking into. And then, Mindy, you guys have 2 daughters, I believe, right? Ultimately, your own demise might be the way to handle this problem, right? The step up in basis. So it might be that, eventually the 2 of you pass, your daughters inherit the stock, they'll get the step up in basis at your death. That means when they go to sell it, their quote unquote tax basis will be the value on the second death. And they could sell it on the way home from the funeral and have very little gain or loss because of that step up in basis. So that may be ultimately how the tax issue is resolved. So I put a lot on the table there. We could chat through any of those. It's a great problem to have, but it is this sort of a little bit of a problem.
I really like what you said at the beginning. Look at what you are spending and what percentage of your portfolio it is. That was really helpful. That question came from me. So that was really helpful for me to kind of reframe my thinking. I'm curious about the donor advised fund. And talking in general terms, you said that I could, if I want to donate $10,000 to a charity, I can donate $10,000 of my stock into a donor advised fund. And then I get all $10,000 in deduction now, this year.
That's correct, Mindy. So now you want to think about the standard deduction and how this plays with your other potential deductions. But what you and Carl could do is you could move money this year. And when I say money, in this case, assets, Google stock, Tesla stock. You can move that over to a donor advised fund. And the way the tax rules work, it's as if the donor advised fund's the charity, right? So you get a tax deduction for the Jensen donor advised fund contribution. Okay. And the financial institution will send you a little letter, validating that, save that in your tax records, and you take the deduction. Great. There's no time limit on spending down. When I say spending down, making donations out of a donor advised fund. So you could say, well, we're not exactly sure which charities we want to benefit, or we want to make a major gift to a donor advised fund, 20,000, 30,000, 40,000, whatever it is. And then we want to use that over a number of years to benefit one or more charities. And folks like this because folks don't want to give, say, 40,000 worth of stock in 1 year to their favorite charity and then say, well, please don't contact me for the next 4 years. And then 5 years from now, I'll give you another 40,000, right? That's not a normal relationship most donors have with charities. Folks like to give the 1,000 a year, the 500 a year, the 2,500 a year, whatever it is. And so the donor advised fund sort of this intermediary, and they're relatively affordable. The fees can be very, very modest at the large financial institutions. But what you're doing is you're accelerating the tax deduction, you're getting that big capital gain off your tax return, and then you just give to the charity on your schedule. And it's fantastic.
Okay, follow-up question to that, and I don't want to get too much into the weeds on this, but donor advised funds are really something that is new to me. So hypothetically, it sounds like, and this is a tax question, it sounds like I could play around with taxes and I want to maybe realize some capital gains. And this would be a deduction. So let's say that I want to give $50,000 over the course of the rest of my life. So I take $50,000 now, and donate it to my donor advised fund. So I'm reducing my taxes by $50,000. So that's my tax obligation. And then I could sell some stocks that equal $50,000 in capital gains, and that's kind of a wash. Does that?
It absolutely can be kind of a wash. So a couple things on that. One, if you put the $50,000 into the donor advised fund, that's it. It doesn't go ever to replace your roof, right? It goes to whatever charity it ultimately goes to, but it can't come back to you and Carl to replace the roof or get a new car or anything like that. That's one thing. But yes, you're absolutely correct. What you could do is you could lower your taxable income by using a deduction for the fair market value of the contribution into the donor advised fund. One little thing to keep in mind, your deduction in the current year is limited to 30% of your so-called adjusted gross income. So that is a limit that you can't just wipe it to zero. But, if your adjusted gross income is $200,000, that means you can deduct this year up to $60,000. But let's say you did a $100,000 gift. Well, okay, fine. You deduct the $60,000 this year. And then next year you get that $40,000. Right? You have, I think it's a 5-year carry forward of that unused charitable deduction. So you just want to be careful with that when you're donating appreciated property. But that's a really good outcome.
So it sounds like I would benefit from a conversation with a tax planner before I make all of these moves.
That's correct. Now I will say, it depends on the circumstance, right? If you've got $1 million and you make $100,000, $1 million income, you make $100,000 donor advised fund, right? This 30% of AGI thing, this limitation is probably not going to really whack you. But in early retirement, and by the way, this is actually an argument for those out there in the audience who are thinking, I'm going to retire in 2 years and I'm going to have 2 years of a lot of income. And then I'm going to be 53 years old. My income's going to drop like a rock in early retirement. You might want to do this donor advised fund today. I'm not giving you advice. I'm just saying, think about this. Maybe this year or next year is the right year because, hey, we're going to have our $300,000 income for the next 2 years, and then we're going to be early retired, and we're not even going to hit $40,000. Well, the tax deduction probably is going to do you a lot better in the last couple of years of work versus the first few years of early retirement, if that makes sense.
Cool.
Okay, so if you've got a big bunch of money that you want to play around with, you should speak to a tax planner too, my dear listeners.
Yes. Okay, on to the next topic. There's one account I love that I think is frequently overlooked because people are so dead set on trying to minimize taxes. This account I kind of think of as a Roth account, but it has a limit. But the really good thing about it is you can hit it up at any time. And this is just a plain old post-tax brokerage account. And part of what makes this possible is what you alluded to, Sean, are very good capital gains taxes. Can you talk a little bit more about this?
Yeah, Carl, you're absolutely right. And this is especially true for those in the FI community who are thinking, hey, I'm going to retire early by conventional standards. So, and in fact, I did a little bit of research yesterday on sort of the timeline on this. So in the year 2004, they introduced for the first time the 0% long-term capital gains rate. And it basically says that if your income is below the second incremental ordinary income tax rate, today that's 12%, your capital gains and your dividends, your qualified dividends, are taxed at a 0% rate. It was originally temporary. It got made permanent in the year 2012. So this is right now the law of the land, and there's no scheduled change to this. If you can keep your tax rate in retirement, you look at all your income, you take out the standard deduction or itemized deductions, but for most the standard deduction. And if you're generally speaking below the top of that 12% bracket, your long-term capital gains and your qualified dividends are taxed zero for federal purposes. Now, they might attract some state income tax, but that's usually relatively modest. But isn't that really powerful, right? You're getting income and you're paying zero federal tax on it. That's incredibly powerful. And you're early retired, right? Your expenses are probably lower. The other thing to keep in mind too is, so let's say, Mindy and Carl get to early retirement and they're just 100% retired, and they're not, no self-employment income, maybe they got a little interest income, something like that, a few dividends, but they live off, say, $120,000, right? They sell some Google, they sell some Tesla. Well, are they, or whatever they sell, right? I'm not giving you investment advice today, right? But you sell some assets in your taxable brokerage. And you say, oh, well, so that's going to be 120 of capital gains income. Well, no, it's not going to be 120. Now, it might be close, but you get this thing called basis recovery. Even in the year 2004, if memory serves, Carl, you bought, like you were saying, 30,000 of Google. You have some basis in that stock, right? It might not be much, but let's say you spend 120,000 in the year by selling 120,000 of Google stock, but you had 10,000 of basis in that stock. Well, okay, great. Your income's only 110,000. And if you had no other income in that example, you'd actually pay zero federal income tax, which is, tremendous, right? So think about you guys would have 7-figure worth. You'd be living in that example on, over 6 figures in a year, and you'd pay zero federal income tax. And let's say, well, no, it's not going to be 120. It's going to be, say, 150. Well, okay, a little bit of it goes above that 12% bracket, and you pay 15% on just a little bit of that income. Maybe that's 2,000, 3,000, 4,000 federal income tax. It's not going to be that much. So, these long-term capital gains and in the taxable accounts can be very powerful, particularly for early retirement. Look, during your working years, right? You make $1 million at work. Yeah, those long-term capital gains will attract 23.8% federal income tax. Well, but first of all, you don't have to trigger those long-term capital gains. You don't have to sell them. And it's a little bit of an incentive. Hey, why don't we get to retirement so that we can trigger these 0% capital gain transactions?
So this that you just said, does that only apply to after-tax brokerage sales, or does that also apply to 401k?
It only applies to after-tax brokerage sales. The 401k is interesting in that it's taxed first, right? So if the only two things you had during the year were long-term capital gains and 401k distributions, say from a traditional 401k, right? Those are the only two things you're living on. That's all you have. Well, the way it works is ordinary income, which is the 401k, it's your interest income, rental income, W-2 income. That's taxed first. And then the capital gains and the qualified dividends sit on top. It's called income stacking. And just the rules, the way the tax rules work. So let's say, Mindy, you're 60 years old, you're retired, and it's the year 2024. I know you're a lot younger than 60, but I just want to use that for this example. You and Carl could, in theory, live on $29,200 of your 401k. So you take a distribution to fund, we want to go, we want to take a trip to Montana, we want to go to FinCon, we got to buy tickets or whatever it is, right? So we spend, the first $29,200 we spend will be from an old 401k. And then you say everything after that will be long-term capital gains. We'll just sell Google, Tesla, whatever we own, we'll just sell some of that. If you did that and you stayed below the 12% bracket, you would pay zero federal income tax. Why is that? The first dollars that are taxed are the 401k distribution, right? In that case, $29,200. Well, you have a standard deduction of $29,200. So you just got $29,200 out of your 401k fully tax-free. And then the long-term capital gains go against the quote-unquote 10% and 12% bracket. But again, that's zero for capital gains. So that income escapes tax-free. So now you guys are cooking with gas. It's one of my little theses in the world of personal finances. Retirees tend to be very lightly taxed. I know I gave you an extreme example, but the tax rules play out very favorably for retirees.
It's completely amazing. I know some folks complain about taxes in the United States, but if you can make use of some of these strategies, it's amazing how little you actually end up paying.
Also, who says tax is boring? This is super fascinating.
Yeah, and it shows, by the way, it shows the advantage, right? So I'll give you a tax basketing concept. So a lot of the folks in the audience want to have some stocks and some bonds, right, in their portfolio as a general principle. Well, isn't it cool to have those bonds in the 401k where the interest income, 4%, 5%, 6% ordinary income doesn't show up on your tax return, and then have equities and taxable accounts? Now, I know we're going to probably have some equities in 401ks because most people have most of their wealth in deferred accounts. But isn't it really cool to hide out the interest income on, in the 401k and then have our equities that generate small dividends, 1%, 2%, 3% yields today, qualified dividends, tax like those long-term capital gains for the most part. You could really cook with some gas with this thing called tax basketing or tax location, and you combine it with, hey, we're going to manage our ordinary income in retirement to stay below the standard deduction, maybe sell appreciated stock above the standard deduction, and yeah, you can cook with gas. And in the FI community, this tends to work better than most, right? The tax laws, I've said before, the tax laws want you married and they want you early retired. And even if you're single, you still get a lot of tax benefit if you're early retired.
One thing that you've spoken a lot about, I think I heard you on the Choose 5 podcast pretty recently, is the value of having investments in different buckets, which I really appreciate. So having things in a 401k, some Roth investments, and even post-tax, so you can pull from what's appropriate at the time per your life circumstance. I think there's a lot of value to that, and I think a lot of people miss that strategy. Like if you had all your money in a 401k, you might be limited. And I know there's ways to get at that money, but they take planning and they're not super simple.
Yeah, Carl, a lot of folks in the FI community love to ask, well, what's the ideal balance between traditional and Roth and taxable? And I don't believe there is an ideal balance. What I believe folks should generally be doing is optimizing for known trade-offs. So I'll give you one example, right? We debate all the time in the personal finance world, the FI world, traditional or Roth. Well, I step back and I say, well, wait a minute, there's sort of two Roths that we're talking about. Roth IRAs, that's the home retirement account, and Roth 401ks, that's a workplace retirement account. And I say, well, what's the trade-offs on each of them? 401k, Roth 401k is okay, but every dollar that we put into the Roth 401k is a dollar we can't deduct today. So that's a big trade-off. That's a big opportunity cost, to use a fancy economics term, right? There's a real downside to the Roth 401k at work, all right? What about the Roth IRA, all right? Most folks who are covered by a 401k at work are not able to deduct a traditional IRA contribution, right? You can make it, but you can't deduct it in many cases. But that Roth IRA is still sitting there. So I think for a lot of folks, the idea is, let's do a Roth IRA at home where we're not sacrificing the tax deduction, and do the traditional 401k at work, because if we do the Roth 401k, that has a real cost. That's a real trade-off that we're sort of, in many cases, losing. We're losing a big tax deduction in our high working years, particularly. So I like the idea of the Roth IRA because we're not losing a tax deduction by doing the Roth IRA and then going back and doing the traditional 401k at work so that we don't lose a tax deduction by using the Roth there.
Cool.
Yeah, I love that. I would say I will make a slight adjustment to your comment. You said you don't think there is an ideal balance. I think the ideal balance is Peter Thiel putting his $5,000 worth of PayPal stock into his Roth IRA that is now worth $5 billion tax-free dollars. But outside of pulling a Peter Thiel PayPal Roth IRA contribution, I like what you had to say. Carl and I are members of Generation X, and I saw this tweet, and I thought it was very interesting. It says, Gen X is facing a brutal reality, retiring as we head into a recession. What the flip do you do? No financial advisor worth a crap has the answer. It's just bad timing for my generation. And I will say that you've definitely not been talking to the right financial advisors, because I've been talking to some, and several of them have really great commentary. But also, this was the period of time, retiring into a recession was the period of time where Bill Bengen's 4% rule didn't work. So it works 96% of the time. It doesn't work 4% of the time. That's not why it's called the 4% rule. It just happens to work out that way. But he discovered that retiring in the 60s, right before the period of, it was like a decade of super high inflation, or that was inflation, not recession. But either way, like it was inflation and recession, and like the 70s was not the time to, be early retired. So what is your commentary to this whole tweet?
Yeah, so I'll just share some thoughts, right? One of them actually relates back to the Bigger Pockets Money podcast. About 4 years ago, you and Scott had Michael Kitces on the Bigger Pockets Money podcast, and you were talking about the 4% rule, and he made a great point, right? The academic research you cite, Mindy, which is highly valid, makes an assumption that is not a great assumption. It has to make this assumption. His point was it assumes you will just march off the cliff. And that is a terrible assumption, right? You're not just going to spend away your wealth and, hey, we just got nothing now and we're done, right? So that would be the first thing I'd say about that issue, is that no one's going to spend right off the cliff and with reckless abandon, or at least very few will. Second thing is, when we think about personal finance, we're thinking about decades, right? We're thinking about decades of accumulation and decades of decumulation. And no one would argue that we should think about 30, 40, 50, 60 years of personal finance in any one of our own lives as recession-free. There's going to be a recession at some point in your accumulation and or decumulation phase. So I think if you have a plan that just falls apart upon a recession, regardless of when that happens, it's not all that great of a plan. I think, most of us should be able to inoculate our finances such that, recession stinks. And I will say, look, there is a problem with sufficiency in the country in terms of if you look at adult wealth and where it is versus what would be needed for a comfortable retirement. Yeah, I argue that in personal finance in America, we have much more of a sufficiency problem than we have like a tax problem. A lot of folks like to say, oh, taxes are going to be terrible for retirees. I think we've demonstrated actually the opposite's likely to be true. But yes, sufficiency matters. And yes, there are problems when you're insufficient, you're going into a recession with retirement. That stinks. But I also don't think a doomer attitude is all that helpful either, right? I think, look, recessions happen. It's normal. And, look, maybe some people are going to have to work more, and that sucks, right? I'm not here to say that's a great outcome at all. That does suck. But, I don't know that I have like a unified theory of a response to that tweet. But I feel like, one of the things that happens, Mindy, in personal finance is the media loves to train us to worry about things, right? Especially, the stock market, it's up, so be worried. It's down, so be worried. And you and Carl and others are doing a great job saying, well, wait a minute, there's a lot of opportunity here, regardless of whether the stock market or the economy is up or down. And I think that's sort of the way I look at it. Not that we'll never have problems, but boy, there are lots of opportunities here.
Yeah, I like what you said. If your plan is going to fall apart because of a small recession, then it's not much of a plan. And I think that is a great response to his commentary. I also don't think he was a member of the FI community. But also, if you are getting to your retirement number or your retirement age and you're uncomfortable with your financial situation or the, economic conditions, then just don't retire. Stay an extra 6 months or an extra year or two, which may not be ideal, but don't retire if you don't have enough money to retire. I mean, that's kind of the bottom line there.
I think that whole tweet is kind of silly because that guy is saying he can predict the future. And if he really can, he has nothing to worry about because there are investments for that too if you're betting on a downturn. So that person would be just fine. All this reminds me of a comment I read. I started my blog at the start of 2013. And I remember there was someone at the time who said, I'm just going to sit on the sidelines. I think the market valuations are high. Can you imagine how much money? I have no idea whatever became of this, but if he has been on the sidelines since January 1st of 2013 till now, he's missed one of the greatest bull runs of history. It's just been fantastic. Okay, well, let's wrap this up, Sean. Tell us a little bit more about your job, and I'd also like to know what you like most about your work.
Yeah, so I'm a financial planner, and more specifically, I'm an advice-only fiduciary financial planner that focuses on project-based planning. So that means what I generally do, I have a firm, through my firm is one-time financial plans. Sometimes I do revised financial plans for former clients and that sort of thing. So I focus on getting the plan in place so that folks can execute on it. I like to help clients get more confident with their financial future, right? Many of my clients, I'll brag about my clients, but many of them tend to be very smart, but they just have some questions. There's some ambiguities here, even when you've been financially successful. And I like to bring more clarity. I like to say I'm not in the 100% guaranteed game, right? Nothing's 100% guaranteed in personal finance, but I like to bring clarity and more confidence to folks as they're working their way through their own personal finances.
Super cool. How long have you been doing this for?
I have been a financial planner for a little over 5 years now. So I'm a career changer. My first career was mostly in public accounting. I was in Big Four accounting, did a little over 3 years at the IRS Office of Chief Counsel, and did a career shift and went into personal finance, got my firm running up in March of 2019. So it's been a little over 5 years now. And, I really like it. I like working for myself. I like working with individual clients. In my first career, most of my clients were large corporations. And you obviously relate very differently with a large corporate client than you do with, say, a married couple you're working with about their own personal finances.
Your 1-year anniversary must have been a doozy.
Mindy, you say that. The one thing COVID did in terms of my business ultimately was it validated a part of my business model. So pre-COVID, I was working, say, 90% virtually with clients. I did occasionally go to folks' homes in Southern California. I'm based in Los Angeles. But 90% of it, California or not, was, hey, let's meet virtually. COVID then fully verified that piece of my business model. And today it's 100% virtual. So if my next door neighbor decides to become a financial planning client of my firm, we're going to work on Google Hangout or Google Meeting, whatever they call it today. So I just, I'm not a dentist. I don't need your molars in my office to render you financial advice. I just don't. So let's do this virtually. It helps clients too, because, think about if you were looking for a financial planner 10 years ago, you had to get in the car and fight LA traffic and interview 5 different financial planners in Southern California. And today, you can sit at your desk in your in your home office, sit on the couch in your living room, interview 5 potential financial planners, regardless of where they are, and make a decision, right? It's so much better from the client's perspective, in my opinion, because they don't have to fight LA traffic to get financial advice and just to vet and to think about who's going to be my financial planner.
So, Sean, are you taking new clients?
My firm is absolutely taking new clients. That is a possibility. I know you guys don't endorse me or my firm, but that is very nice of you to ask. That is absolutely a possibility.
And where can people find you and your firm?
So my firm is MullaneyFinancial.com on the internet. You could find me on my blog, FiTaxGuy.com. And as a little bit of a side related project, I'm doing more YouTube content. So if you go into YouTube, just type Sean Mullaney. Sean Mullaney videos, my little YouTube channel will pop up, and you can get a video every Saturday morning.
Cool. One final question, Sean. I've seen you in person at a couple different Money Fi events. Are you going to any this year? And if so, which ones?
I've got a couple coming up. I've got I've got Camp Fi Rocky Mountain Week 2, which is in mid-July. So I'll be in your neck of the woods. I'm going to Bogleheads, which is in late September. And then FinCon, which is money, it's more communication, but it is somewhat money related. That is in late October down in Atlanta.
Super cool. I think I'd like to have a conversation with you at one of those where we hold up. I'd like to have a conversation with you on one of these where we actually don't talk about, as much as I love talking about 401ks, Roths, post-tax, I think about this stuff like half my waking hours. It'd be nice to have a conversation with you about something else. So let's do that either at Camp Fi or at FinCon.
Absolutely, Carl.
Okay. Thank you so much, Sean. We super appreciate your time.
Yeah, thank you for answering our listener questions.
Thank you guys for having me. Really enjoyed the conversation.
Cool. If you're watching this on YouTube, I feel kind of self-conscious. I was just working out in the yard and didn't really clean up before this.
Nice.
Yeah, at least the smell can't come through the computer.
Wow. Comes through my nose.
Okay, what are we doing here?